Airline Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Airline's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at airlineresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is David Skarica, founder of the Addicted to Profits newsletter, online at addictedprofits.net. He writes for the Financial Intelligence Report, and he's speaking to us from the Bahamas. Welcome back to the show, David.
Yeah, on lockdown. So I guess there's worse places to be on lockdown. Like being stuck in a 800 square foot apartment in New York City is probably a lot worse than being in the Bahamas.
With a great view of the alley.
Yeah, with a great view of the alley. Yeah. So, yeah. So.
David, the markets right now, we've had a lot of up days. Is this a return to so-called normal, or could this be a trap?
Well, technically, you could tell there's these indicators you look for. Like you want to see Martin Zweig, who was an old stock market analyst from the 80s. He had something called double barrel days, where you want to see a couple 9-to-1 up days, and within a couple month period, and no 9-to-1 hit down days, volume up to down volume. And we saw a couple of those at the bottom, signaling that this was going to be more than a few day rally. And if you go look at the way the market crashed, it crashed. About 30 to 40%. I think 40% was basically the intraday low. And similar actually, 87 was 35 to 40%. So a retracement, 50, 60, maybe even 70% is kind of the norm. And what worries me is I don't like the V bottom kind of thing. Usually technically what you'd like to see, and this is what happened in 87, is you get a rally, the market's very volatile, bounces around, the retest maybe a couple months later, and then it's kind of up and away. So usually when you get these V rallies, and some examples of these would be March 1990 in the Nikkei, March, April of 2001. Usually when you get that sort of thing, August 2007, the rally can last for a few months, but then it kind of rolls over. And I think right now, like my own personal opinion is people are delusional on what the economy is going to look like after we're done with COVID. They just think, most people are thinking everything was booming, and this kind of took us off the rails, and then, we'll just go back to being booming afterwards. And the issue I have is that I don't think the economy and the market should have traded like this, even if it was shut down for a month or two, because, 1918 was way worse in terms of the actual pandemic than what's going on now. And a lot of the economy, shut down, and people don't actually look at this, but a lot of cities actually had lockdowns in 1918. I think Philadelphia and Portland were two of them that did it, or restricted hours, etc. And the economy didn't collapse. And why did that happen? It's because we weren't as leveraged. People didn't have mortgage debt, credit cards, car loans, etc. So I think what happened was really this bubble that the Fed built since 2009, since the financial crisis, got exposed. And that's why everything crumbled so quickly. And that's why you're seeing such mass unemployment, because almost every sector of the economy, even down to restaurants, are so leveraged that now when they just don't have business for a month or two, they've totally collapsed, right? And, I'm not the richest guy in the world, and I still have a mortgage, but if I didn't make money for a month or two, I would still be okay, right? I could still at least squeeze out a few mortgage payments. But you go look at Subway and Cheesecake Factory, companies these huge multi-billion-dollar companies basically said that, without, months of business, they can't pay their rent, right? So I just think that's a sign that the economy is way too leveraged and there is way too much debt, and this kind of just exposed it. And then, of course, there was this huge misallocation of capital with, companies doing buybacks, like the airline industry. If you go look at the size of their buyback, or especially the size of their bailout, it's basically the amount that they bought back in stock since 2010. So maybe if they didn't buy back that stock, they'd have a nice little cash stockpile to withstand this, right? So I just think this was all exposed. But in terms of get back to the market itself, it's like I said, in those rallies that I talked about, like in 01, in Nikkei 1990, the most famous one is after the crash of 1929, the market rallied to March 1930. Usually it's very similar to this, that, you get this maybe few weeks or month-long rally that's very ferocious, and then the market kind of tops out over a number of months, and then kind of starts to roll over, and then really falls, 6 to 12 months after that, the top of the bear market rally. And that second leg down looks a lot different usually. In 2008, the second leg down was ferocious, but usually the second leg down, like what happened in the fall of 2000 or what happened in the Nikkei that fall, is more a representative of what usually happens, which is it kind of just the market just kind of grinds lower and lower and lower. And that's what I think is going to happen, because I just think we're going to be at the very best a W-type recession, and at the very worst, an L. I just can't see a V happening. Like, for example, I think I saw a stat, and you're in Vancouver, like 65% of people in Vancouver can't pay their mortgage in May. I just don't see how you can have a V-style recovery with this many people, like, struggling financially. And by the way, the one thing I will say, Vancouver and Toronto housing markets, anyone who can't pay their mortgage, with all due respect, I have absolutely zero sympathy for you, because if you were buying $2 million dump in Toronto or Vancouver and thought it was worth $2 million and was going to $3 million, you're an idiot.
Companies that are getting bailed out, as you mentioned, the airlines, I think they're getting $45 billion. They bought back $45 billion in shares. Should companies like that be bailed out?
No, I think the most prudent, when the airlines got bailed out in 2001, none of us mind, right? Because they weren't as badly run. They weren't doing stock buybacks back then. It was something that was out of control. A couple planes got flown into the World Trade Center. So there was a small bailout back then. So none of us really, were against that at the time. And it was, much smaller in terms of the dollar amount. And it wasn't like the whole economy being bailed out. So, at that time, the federal government didn't have to plunge into debt to do it. But now, no, I don't think so. I think these companies, managements are incompetent. And remember, we all know that we get horrible customer service on the airlines now too. You don't even get a bag of peanuts anymore. So they were, on top of buying back stock, they weren't even spending it in the business. We actually, on the manufacturing side, we know the corners that Boeing was cutting, and they were doing huge stock buybacks as well. So no, I think the more prudent thing would have been to say, okay, all the airline employees, you can get whatever 50, 60, 70% of your wages for the next year to kind of while you're looking for another job, or while the airlines restructure in bankruptcy, and then come out of bankruptcy with new management, or their assets are taken over by other companies, etc. And I almost think that the airlines should be broken up, because if you go look at it, we're very concentrated in the States. Like, remember there used to be dozens and dozens of airlines, and you have local carriers and that sort of thing. And I think that's another issue, is that you got these 5, 6 big airlines that are so large, they run most of the routes in the United States. And maybe if they failed and went bankrupt, you'd have more of these small kind of carriers starting up, people that would service the Northeast or the Southwest. That's Southwest itself. That's originally what it was doing. It was just, running out of Dallas and, going to local routes and that sort of thing. So I think that, the airlines, a more prudent measure would have been to let them go bankrupt, let all those managers lose their jobs and get fired, and the CEOs for being incompetent, and then giving the people that actually work there, the stewardesses, the repair guys, the pilots, like I said, a % of their wages, and while everything can be restructured in bankruptcy. And by the way, we all know airlines is a horrible industry. Like, two of the largest airlines in the world used to be Pan Am and TWA, and those both went under. So it's like, we all know that airlines going under is not anything new.
Should buying back shares just be outright banned for anybody?
Yeah, I think they should. Like, they were actually illegal till 1982. They were seen as a form of insider buying. And the idea was a company would know how its quarter's going or the whatnot, and could be buying back shares knowing that, okay, we're going to have a good quarter, even with the 5-week blackout period, because, there's roughly 12 weeks in a quarter, right? So it's like they'd have the first 7 weeks, there's 12 to 13 weeks to 7, 8 weeks to know what's going on, right? So, and then when they used to be used in a prudent manner, like after the 87 crash, one thing that put a buffer under the market was companies bought back their shares because they were cheap, which is like prudent. But now this is an offset of cheap money. These companies can borrow so cheap, corporate rates are so cheap, they were just borrowing cheaply to buy back stock. And remember, what they're trying to do is prevent dilution, because that helps that helps options, right? Because if you go look at a company, companies usually dilute by 1 to 2% a year, because when you exercise options, those options get turned into stock. So what they were trying to do is keep that from diluting to keep their earnings per share high, and then also have less stock outstanding, so the share price could become elevated, and these guys could exercise their stock options. But I just think that they have acted in such a reckless and almost like childish manner in terms of this. They're just, they're like 5-year-old out of daycare. They just need a lot of rules, and I would personally outlaw buybacks, or at the very least set up something like a rule. And I'm not even talking about anything tied to the bailout money, just something that, look, do you guys think your shares are so valuable that you're buying them back with company money? No insider at the company can sell stock the same quarter that you buy back stock. Because that's also, when you think about that, how big of a conflict of interest is that? To be buying back your own stock with company money while you yourself on the board are dumping shares. You're basically, using the company money to buy back your own shares. Now, if you did that on a penny stock, they would call that like, you mark the stock up, you cross it up, between your own accounts or something. It's almost like something like that. So it's really got to change. And I think one thing that's just going to change it is the public perception, because now if you've got mid-double-digit unemployment or higher, mid-teens, or higher, how can companies look at these people, that they're firing or people out of work and still spend billions on buybacks? And by the way, I don't think it will happen, because now here's the ironic thing, just to end off now, like Carnival, the cruise line, was an example of this. I looked it up, and they reduced their shares outstanding by about 60 million, from about 670 to 610 from 2016 to 2019, a 4-year period. Well, they had to do an equity raise of 50 million at $8 just to kind of stay alive here, because they couldn't get bailout money because they're registered offshore. And that's over 60 million shares issued. So boom, those 4 years of buying back stock and whatever, $40, $50, $60 a share were reissued onto the market at $8. That's called buying high and selling low. So, and I think they're going to see more of that, because companies now are actually going to, as business is weak in the coming years, they're going to want to get out of debt. They're going to want to deleverage. And when they deleverage, I think one of the ways they'll do it is they'll sell equity. And when they sell equity, they're going to be selling these stocks at, 30, 40, 50% of what they were trading at, in early 2020.
On the old Vancouver Stock Exchange, I think they used to call it pump and dump.
Yeah, that's what they're doing. It's like, it's funny, like, we all know that those VSC guys had notorious, reputation, and rightfully so. But, these guys are almost just as bad, and, but they're just doing it in they found a loophole through this buyback of kind of doing pump and dumps in a more legitimate, kind of fashion.
We'll have more with Dave Skarica right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration, with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with David Skarica, David, when oil went negative for one day, that's never happened before in history. Do you think it'll happen again?
I don't think so, and I'll tell you why. Well, firstly, one thing that happened is the ETFs played a major role in that, because I don't like any of these commodity ETFs because they actually don't own like the physical. You got Sprott's gold and silver ETFs. They actually own the physical, and they have a vault somewhere and gets audited. But even the GLD and SLV, happily they don't own the futures. They own just certificates, right? So that's closer to owning the physical. But a lot of these others, you can't store a bunch of oil somewhere and just sit on it. So, they have to buy futures, right? And because oil is like used a lot quicker than say gold is, gold can just sit there and use it as money. They have to, they can't just, like I said, they can't just buy a certificate of oil. So they use futures. So what was happening that day, all these people buying those ETFs essentially, and I think other funds were giving it away because there's no storage and you have to deliver it. And usually what happens when the ETFs would roll over a contract, they would just make a deal with Cushing or one of these things, and whatever they had would be transferred over to Cushing, and that's your delivery, and then you just roll the money into the next ETF. Well, now you can't do that. So, but these guys roll over it, a few days, not all of it the last day. They do it a few days, or like if they did do it that day, they're already buying, the June contract. So all these people buying the USO, they thought they were buying oil at negative or zero or whatever, but they were actually buying the June contract, which at that point was trading at 22. It's about 15, 16 now, so they've lost another 30 or 40%. And it becomes a huge problem because these people think they're buying oil at these super low levels, but they're only buying the next futures contract, and they've had so much inflow into that USO, people thinking they're getting the bottom of the market, that I think it owns like 30% of the oil that's on the market right now. So it's just become, self-fulfilling prophecies. When that ETF has to roll over and has to do delivery and has to sell, they crush the market. But the reason I don't think it will happen again is because I think is JP Morgan, one of the brokerages that owns one of those ETFs, already instructed them to roll over into the July contracts. And they did that. That was the day you saw oil down about 25% to like $12. And they did that to kind of prevent that big flush that will come at the end of the contract. And really, there's going to be a lot of demand destruction now. I'm sure the Saudis and the Russians now are going to do a much larger cut. So I think what will happen is the economy is probably not going to return to where it was in early 2020 anytime soon. But even if the economy starts to open up a bit, is a quarter of half of what it was, because of the supply side destruction, that amount of demand will probably push oil back up to $30 or $40. And I don't think you'll ever see that again. I think that was a real anomaly. And again, I talk about the buybacks and the an example of cheap money. So the thing about it is, that's cheap money as well, like with oil, because all these frackers could borrow for nothing and then, buy oil, produce oil at a loss for years and years, and people just kept lending them money. And these companies are all cash flow negative 75 at 50, and they sure as hell are cash flow negative at 15. So I think that was another example too of this cheap money blowing up, where you had all these producers who really shouldn't be producing in an uneconomic model. And it's almost like these fracking companies, a lot of them are mini Ponzi schemes. Because what's a Ponzi scheme? As long as the money keeps coming in, you can keep paying out what's going, the people, the investors that want out. Well, as long as they could keep borrowing at cheap interest rates and the banks lend it to them, they could keep producing oil, which was uneconomic. So that, I think that's coming to an end as well. And when some of those smaller companies kind of go to the wayside, I think that's when you're really going to see this. You're going to see, the supply come off, and then when a little bit of demand comes back into the economy, that will help oil prices go higher. And I think the Russians and the Saudis, I never believed that they were in a fight. I believe that was kind of coordinated to crush the frackers. So I think that once they take some more supply off the market, then you'll see them maybe start controlling the market a little more again. Now, I could see, because the current administration in the U.S. is so nationalistic, I could see duties on Saudi and Russian oil to try to protect that industry as well too, which would be really bad because you would probably have a zombie industry then where, these guys will basically stay afloat, but, but consumers are going to be paying a lot higher prices.
We'll have more with David Skarica right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with David Skarica. David, has silver been a big disappointment after gold's big-time climb to the sky?
Well, not for me, because I bought silver the day it bottomed. So, and it's had a bigger jump. I bought some call options on Pan American Silver, which I just recently sold, and I still have some call options on the SLV, which is about doubled. And the call options on actually, and I bought a couple of small junior companies. I think the problem with silver is it has a lot of industrial uses, and and if you actually look at these crashes and recessions, it usually dumps during that time. And then it usually outperforms afterwards. Now, this dump was an extreme, because we've seen that gold to silver ratio go to basically an all-time high. So I guess it's somewhat been disappointing, but I think in a deflationary environment, because of all the industrial uses for silver, it will underperform, and I think it could still not really start to outperform maybe for another 6 months as we're in kind of this deflationary stage, I think, still. But I think coming out of that, it will do wonderfully and do fantastic. So, I definitely think, like I told you, those are just call options. So, those are trades, but I think on the longer term, I've seen a lot of my little silver juniors and some of the producers. I bought Coeur d'Alene near the bottom as well. I've seen these stocks, do very well. And I think those I'm just going to plan on holding for a number of years. And I do think, again, once we kind of go from this deflationary kind of stage into a more inflationary or stagflationary stage, I think that's when silver will really outperform. And by the way, silver didn't do that well in the early 2000s as well. It really wasn't until the latter stages, 2010, 2011, where silver really outperformed. So sometimes you have to wait a while for this outperformance to start, Is
this the time then to acquire silver and anticipate it'll go up?
If you told me right now, would I rather own silver or gold? I would rather own silver, because another aspect of silver, to me, where gold is your dollars, silver is your cents in monetary terms, in the precious metals. And then also the retail guys are the guys who tend to drive silver, where gold has more institutional money, has the central banks buying. So I think the retail guys, because you've seen this nice rally in the stock market, they're still not really in the precious metal sector, even though, gold has gone to new highs and the gold stocks have actually broken out to new 52-week highs as well. So I think what will happen is once we get that second leg lower in the stock market and the PMs really hold up a lot better and then are really the best performing kind of sector, I think the retail guys will really get drawn to it. And because silver is so volatile, it's really the type of people that were in crypto, that were in marijuana stock, I think actually they'll be really driven to silver and silver miners and that sort of thing. So right now, I would rather own silver over gold, but my warning would be, in the short to intermediate term, it could have more downside and may not start outperforming. But I like relative value, and I see a lot more value in gold silver at 15 and than gold at 1,700. And by the way, I did this with copper back in 2009. I remember I spoke at a conference, and at that time I think copper was trading at 140 and gold was close to 1,000 an ounce. And I just said, and just a year earlier, gold was near 1,000 and copper was at 4. And I just said, on a relative basis, copper is much cheaper, and I'd rather melt down my gold and turn it into copper. And a couple of gold bugs got really angry at me. But if you go look what happened, copper went back to $4, where gold, I think went as high as 1,800. So copper nearly tripled, where gold only went up about 70, 80%. So, I think you have to look at this kind of relative value. Like, you could argue, we mentioned oil earlier, that oil might be just as good as a buy. I think that's going to take a lot of shakeout, but, in the next 6-12 months, kind of averaging in to some oil equities, some oil as well, because again, oil is so cheap. And see, my basic thesis right now is we're in the midst, even with this recent rebound, of this kind of deflationary bust, and that will turn into some kind of stagflation or inflationary move once we get through another liquidation phase. And I think the next liquidation phase is different in that it's not just the stock market, it's like everything. It's like we talked about, I talked about Toronto and Vancouver housing, or we talk about another bubble was the subprime auto loans. I think when the economy has shown to not have extremely strong economy in the next 6 to 12 months, the people who bought those overvalued assets, like physical assets, like real estate, like automobiles, they have to start selling those. And that's when you can kind of see the next leg lower, driven by more economics than just like, than the COVID.
David, how would you sum up what's going on right now?
This is probably the craziest thing I've ever seen, and I'm not that young anymore. I'm not old, but, I'm in my 40s now. And I remember when 2001 happened, 2002, I don't mean 9/11, I mean the dot-com bust. 9/11 was part of it. I was just like, oh, you got a terrorist attack. These tech stocks, you look at the parabolic move in 99, 2000, did what the market did in 29. I'll never see anything like, they went down 80%. I'm like, I'll never see anything like this again. And then 08 happened, and the government had to come and bail out all the banks, and, market went down 50, 60%. I was like, I'll never see anything like this again. And I still was worried. I've been predicting a bust for the last few years. But this, a pandemic, people are on lockdown, the market, the U.S. government, is going to run a bigger deficit as a percentage of GDP than it did in World War II, any year in World War II. It's just unbelievable. So, I would think I could say, I don't know if we'll ever see something like this again, but considering, I'm in my 40s and I've already seen 3, this is the third one I've seen, I don't really want to say that, because I think actually the next bust is going to be the bust where the governments go broke, because I talk about inflation, and at some point, you can't just keep spending and printing like this, and interest rates stay at 0. And you got to remember, just think how dangerous it is that U.S. debt goes to 30 trillion, is 150%, 160% of GDP, and all of a sudden, rates, even if they creep up to 3-4% on the 10-year, they're broke. Same thing with Canada. So I think that will be the next shoe to drop, and that might be the fourth and final, I'll never see this happen again.
David, thank you so much for chatting with us.
Thanks for having me.
My guest has been David Skarica, founder of the Addicted to Profits newsletter online at addictedtoprofits.net. He also writes for the Financial Intelligence Report. If you have any questions for David or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.